Hi everyone, it's Chad back with another video. Today I'm going to be talking about Verizon, US telecommunications giant, one of the remaining remnants of the Bell system along with AT&T and Lumen. It is the largest wireless carrier in the US with 142 million subscribers. Stock has lost to the market over the last 5 years but paid a nice 4.8% dividend, and due to earnings growth in this time, the multiples have compressed greatly. Perhaps there is opportunity here at a relatively low price. First of all, I want to take a look at the biggest red flag for this company and the bear case essentially, which is the balance sheet. Balance sheet is not too dissimilar from its rival AT&T. Cash debt position is very weak at 0.02. This is due to a debt load of over $140 billion to cash on the balance sheet of just 2.9 as the most recent filing. The company has been assigned an Altman score of 1.37, indicating the company is at risk of financial distress. All of this ordinarily would make this company thoroughly uninvestable to me. However, Verizon has excellent cash flows, shows up mostly in the operating cash flows. The free cash flow is a bit sketchy, and is basically a utility company. This is extremely reliable revenue, has good interest coverage at 9.31, decent debt to EBITDA rate at 3.62. Obviously, in a normal company, this would be horrendous, but when it has 140 billion in debt, that's not so bad. Has a really strong credit rating from all three major agencies. I think it's BBB from Standard & Poor's. Not overly concerned at the minute. Cash intensive business, capex intensive, but debt load can be managed, as is happening with AT&T at the minute. Need to see this move in the right direction from years of mismanagement. Margin to it, on the other hand, are absolutely fantastic. Operating margin of 24% and net margin of 16.5% are both absolutely fantastic numbers for this industry and fantastic by this company's own standards. Return on equity percentage of 29.69 is absolutely outstanding for these type of old world, slow, boring businesses, and you can see by the industry number, absolutely excellent. Return on assets percentage of 6%. This is a very asset heavy business, so that does not surprise me whatsoever that this is a relatively low number, but it's not unimpressive in its own right. Return on invested capital of 7.67% is okay, not amazing, but pretty good for a company of this size and maturity. Looking at some basic valuation metrics, first one I want to look at here is the PE ratio. Price to earnings ratio of 9.9 on a trailing basis, and on a forward basis 9.68. Not too dissimilar because this is not a company that's going to be blowing the doors off with growth. Both significantly below the S&P 500 average as we speak. I think the trailing average is at over 20, forward slightly below 20. Like I said earlier, not really happening with the share price in the last 5 years, but slow and steady earnings growth has squeezed that PE to now under 10, very similar to that of industry peer AT&T. Analysts are predicting modest revenue growth and earnings per share growth for the next few years. There's 1.9% revenue growth for the next couple of years, 2.83% EPS growth for the next few years. This is completely to be expected for a utility-like company at essentially market saturation. 2% revenue and 3% earnings per share growth is exactly what I would expect for a company executing at this scale. All the valuation metrics are far below what they normally trade for. Again, P ratio under 10 is exceptionally good for Verizon's history and strong for the industry. Price to operating cash flow of just 5.5. This is a company that produces excellent cash flows, and that is a very, very low number. Next up on my list of analyses is a discounted cash flow valuation to work out the fair value of the business based on its future cash flows. Free cash flow is all over the place with this company. The data just really is quite sketchy and unavailable, so I'm using the data available to me and doing a discounted cash flow calculation based on earnings per share, which I think is relatively fair. I believe Verizon can continue their 5-year average growth rate of 3.3% and broad analytics expectations 2.8% for the next few years. I believe 3% is a fair assessment for the next few years going forward. Using this and a 9% discount rate gave a fair value of just above $60. I've accidentally inputted a terminal stage growth rate of 4%, which again, not completely unrealistic, won't affect the price that much. It will still be above $60. Compared to today's stock price of just shy of 53, this is a reasonable margin of safety and good discount to fair value in my opinion for what is a company with excellent pedigree, pays a nearly 5% dividend, and is slowly going to be sorting out its balance sheet with what must be said utility-like revenues and earnings. So these earnings are not going to go away in times of recession, in my opinion. Wireless internet and anything like that is now essentially a utility. It's essentially something we all need for daily life. I went looking for some red flags, looking at the most recent financial reports, see if there's anything that I'm not seeing. Looking at the most recent financial report, Q4 2021, revenue down slightly for the quarter compared to the previous year, down 1.8% year over year. But for the wider year from 2021 From 2020 to 2021, year-over-year growth 4.1%, right where I'm expected for this company. Pretty strong financial performance. This is mainly driven by strong performance in the wireless service revenue, up 4.7% year-over-year, and up 6.5% from fourth quarter 2020 to fourth quarter 2021. All relatively good numbers. Taking a look at how the company's guiding for 2022 compared to analyst expectations, 2022 guidance looks largely uneventful. Excluding VMG and TracFone, revenue to be up 3% and EBITDA growth also between 2 and 3%. Importantly, CapEx is coming down slightly from this year by about $1 billion, but capital expenditure is still going to be expected to be between $16.5 $17.5 billion. This is weighs heavily on the free cash flow and why operating cash flow is a better metric to use for Verizon's cash generation. Adjusted earnings per share right now, $5.50, expected to be between 5.4 and 5.55. Not much change here, again, because this is a utility-like company nowadays. They're investing a lot of cash. This is to be expected. I always like looking at management's priorities whenever they declare this in a financial statement. They want to deliver financially, which of course they do, which I expect them to achieve. They want to maintain a healthy balance sheet, which obviously we differ in opinion here on what a healthy balance sheet is, but they're hardly likely to say that they've got an absolute pig of a balance sheet. I think this is reasonable that they want to at least maintain the situation they're in now, not taking a ton more debt, because they can service the capex with cash flow. Strengthen the core businesses and continue to push the leadership in 5G, C-band and other technologies. Again, completely sensible. They want to grow the core businesses, drive differentiation through like ultra-wideband and through TracFone, and improve their already widening gap to the rest of the players. I think this is completely sensible. I would of course like more focus on repairing the balance sheet, but overall I think these are absolutely sensible decisions from a good management team. Overall, I like the business and I think it is investable at these prices. I think there's a good enough margin safety at 15 to 20% below fair value based on 3% earnings per share growth that I can get on board with investing in this company while it has $140 billion in debt. It has a $223 billion market cap, so it's not one-to-one with the market cap just yet. And it's not so worrying because ratings agencies are clearly not worried and they are often far more conservative than the average investor. But I'd really like management to wake up and start working on that debt load and using some of its cash to work on the debt load. Warren Buffett bought $8 billion around these prices in Q4 2020. He still holds, he hasn't been adding, and he's probably just been picking up the dividend and they're quite happy to do so in that time. Clearly he recognised that it was below fair value, as I believe I have done. I think he's a pretty smart investor with a pretty good track record. However, it's not been a great investment so far. I think overall, it's so similar to AT&T. With the obvious question is, which would you rather buy? And right now, I'd probably rather buy AT&T, truth be told. Like Verizon as a company, I just think AT&T has more going for it. And I think the split with Discovery has some good opportunity for price changes to that company. That's more of a catalyst because both of these businesses have had very few catalysts over the longer term. However, I think Verizon's core business is more stable. So I think in the longer term, Verizon will probably do better. But again, we just need the market to wake up to these opportunities, which who knows when it will. But for the meantime, 5% dividend is quite juicy, and I think it's relatively safe in the medium term. So having said that, now this is financial advice. You should do your own research and due diligence, or contact a registered financial advisor. Thanks for watching the video. Like and subscribe if you're enjoying the content. I'll see you again next time.